All right, so here is that chart. Again, 15-minute time frame on the E-mini NASDAQ 100 futures contract for March delivery 2022. And take your attention over here. Okay, this old low and these relative equal highs. See that? Old low, below that is sell stops. And relative equal highs, above that is buy stops. Now, you could have used this high here. There's nothing inherently wrong about that. But whenever I see equal highs like this, and if it's higher than an old high over here, I'm going to use that. So that way there's a little bit of insight for you for your study journal. The sell side liquidity, you can see that the market trades down, hits that, runs through it, then rallies all the way back up, clearing the equal highs. So the buy stops have been taken here. Okay, so at both of these price points here and here, that's the, I guess, the point at which you'll look for or anticipate a market structure shift. And you don't force it. Okay, I see a lot of people try to teach my concepts. It'll talk about market structure breaks or shifts, and we'll use that term interchangeably. But for intraday, I want you to think about intraday market structure shifts, because it's not necessarily a break in market structure that leads to prolonged multi-day movement. Okay, what do I mean by that? If you see a market structure that's bearish and it's broken to the downside intraday, that may just lead to an intraday price leg that may eventually see that high be taken out in the same day. So that's why I'm using the term market structure shift, not market structure break. For our conversation here on this mentorship, just know that when I'm going to lean on that term market structure break, it means a little bit more in context versus an intraday shift in market structure. It just means that there's likely a downside draw or an upside draw intraday by saying the term shift. Okay, so there's a little bit of semantics there. All right, so we have both of these areas here and here where there would be a likelihood of a market structure shift. Up here, we look for a fake run above here. So that fake run above, how do we know it's going to be a market structure shift that's bearish? I get that question a lot, even from mentorship students. What you're looking for is the evidence I'm going to show you here tonight, okay? Forget everything else everybody else says about market structure breaks and shifts and all that stuff. This is it, okay? This is the brass tacks. There's absolutely nothing else that you need to know about it. I promise you. If they add anything to it, it's just because they want to sound and look different. But this is the algorithmic perspective of a market structure shift intraday. If you look at this short-term high here, right before this low formed, when this high is taken out right there on that candle, that's significant. Only if this run down here has traded into sell stops, okay, below an old low of some kind. It could be a double bottom, it could be a single low, okay, but it's got to be trading under some retail idea that would be viewed as support. Up here, the same thing. We're trading above highs, so we know that above old highs, a neophyte's perspective will be, these are unknown orders, so therefore that's a flawed perspective on price action. How do you know there's liquidity up there? How do you know there's buy stops up there? It's just logic. It's simple. Look at the chart. Everybody's trying to do something based on some kind of theory, logic, whatever, some system. There's buyers and sellers coming in at all times. Their buying and selling quote unquote strength or pressure has absolutely no bearing on where these prices are going to go. I know that run above these relative equal highs happens right there. You're anticipating a market structure shift. You're not forcing it. You're not trying to get ahead of it, okay? I don't think any of you are going to have the skill set to do that. There are ways to know when to sell short right above that and not even wait for the shift in market structure. Just like there's ways to know to be a buyer down here without seeing that short-term high broken, then looking for a buy. Over here, the opposite. See this swing low? Let me go back to this for a second. We have this high on this candle. Then we have the candle right after that here, the highest one. And then the lower high of this candle here. So that's a swing high. Very simple little pattern, but it means a lot when it's in the proper context. When this high is broken with this particular candle right there, that is significant only on the basis that we have taken liquidity out of the marketplace. That's it. So when it broke this short-term high, this is more meaningful. And then the market will start to seek buy stops, okay, or buy side liquidity. That would rest above here, here, and here. All I'm going to do is add a few annotations, and this is about as extensive of lipstick we put on our chart. I know it's shocking, right? Can you still see the candles? Because it might be a little obstructive. I'm being facetious. You see these guys out there with these charts that have graffiti all over it. You can't even see the price candle. Nothing. You can't even see any of it. But there's all kinds of overlays of all kinds of nonsense, which means absolutely nothing because algorithms could care less about any of that stuff. Triangles, harmonic this, crabs. It's crazy, I know. But hey, everybody's got to have a religion. So here's those sell stops. So this little area here that's shaded in, that's a area where sell stops would be residing below that 14,600 level, okay, on that 15-minute time frame. So the market dove into that liquidity, and you may or may not know that is a buy. You don't need to. You anticipate a shift in market structure. When the market rallies above, when does that happen? On this candle right here. See that little light bulb? That's when you're thinking, okay, now I have a condition in the marketplace that I might see an opportunity intraday. Let's see if there's further evidence to that. Short-term high is taken here. We traded above it. It does not need to close above that. Okay, real important. Once that candle closes and this candle opens, you're going to monitor this candle. And you want to see as soon as this candle closes, does it create that fair value gap? If it creates a fair value gap, again, that's a candle with a high, one single pass up. Next candle has a low that doesn't completely overlap all this. That's a fair value gap, real simple, okay? This candle is where you would look to potentially trade at the earliest because now there's a gap there. The market trades down into that, boom, takes off. Here is insight that everybody needs to understand because they're out here running around on YouTube trying to teach order block theory. Order blocks, okay? I invented it. It's mine. No one talked about it before me, and I first mentioned it in 2010 on baby pips. Prior to that, 1996, I was only teaching it to people one-on-one in teachings. That's it, okay? You can't find it in books prior to that. It's mine. No one else taught it before me. It is mine. So I'm going to correct all of you today so that way you can teach your people correctly and not hurt them. See these down closed candles? See that? That's all one continuous order block. What's it doing? It's inside that pool of liquidity, sell stops. Where's the open on that series of down closed candles? Right here. That's the price level extended out in time. Boom. So inside this fair value gap, this opening price on the order block, that's your buy, plus 3 pips or whatever for spread. And that's what you would use for a limit order. That's pretty neat, isn't it? Well, price starts to run where? Above the highs where buy stops would be here, above this high here, and above this high here. Now, let's go into a 1-minute chart and see how that looks a little bit different, but still has the same characteristics. Here's that same price structure, just on a 1-minute chart. The same logic still there, right? Swing high taken after liquidity's been traded into. This short-term high gets violated. Right when this trades down in here, what's actually occurring? Okay, put this in your notes. High-frequency algorithms are hammering. They're just throwing orders in, buy, 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 buy. That is not, okay, here's the important thing. That is not causing, okay? It's not causing the market to go higher. It's just volume that's coming in. The algorithms that deliver price, that offer price, they're constantly offering the price in the marketplace, that's what's beginning to spool and go higher, okay? And regardless of where you want to trade at, your limit orders, they may not get filled. Where you're trying to buy with a market order, you may think you're getting in at 14,662, but by the time your order is executed and confirmed, you're in 14,664. That's slippage. Okay, that's negative slippage. If you were trying to buy it at 14,662 and it filled you at 14,661, that's positive slippage. That's better than what you were expecting. So when the price starts to rally, all this is a default to the algorithm constantly offering price at a higher price. Okay, and the logic and argument for anyone that wants to say, oh, it's buying selling pressure, this guy has no idea what he's talking about. I know somebody that used to trade on the floor and he's laughing at ICT right now. Okay, go into your charts. Forget that. I'll let you have that perspective for a moment for the argument. But go into the charts and see if what I'm not suggesting to you is the truth. Okay, I could sit here and do a complete series on all the things that lead to what I'm saying is true, but none of you will still believe it. I'm showing a live account and entries and executions, and they're still doubting it. So no matter what I do, there's going to be people out there, but you didn't do it wearing orange. You didn't do it in your Corvette that you flip, which I don't flip Corvettes. You're getting all kinds of stuff out there, nonsense. But you don't see anybody going into that Robbins Cup. Hello. So we're looking at the swing lower here. Market breaks down, trades back up into this fair value gap here, and sells off. And there's another fair value gap right there. Trades up into that as well. This is a 1 minute chart. So it's giving you multiple points of execution that you could trade on, and then dives. See these two candles here? That's one consecutive bearish order block. The opening price extended out in time. Why is this a good bearish order block? Because it has that gap and it's taken liquidity. And there's a market structure shift. There's your high frequency, high power, high probability bearish order block. Forget everybody else's interpretation of my concept, the order block. That's it. Okay? What is an order block? You see a lot of people asking, what is an order block? Only my students in mentorship know what an order block is. Okay? What it is, it's a change in the state of delivery. Okay? It's a change in the state of delivery. The market's being offered higher, 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 higher in these two up-close candles. How did this series of up-close candles begin? With this candle's opening right there. That opening, once this candle trades below it, that changes the state of delivery. So you go back to that point of reference right there. And that's why it's sensitive. The algorithm remembers that right there. Okay, that's all I'm going to give you on the free mentorship level. But that is your answer. Okay, that is what an order block is. It is a change in the state of delivery. Much in the same way, all of this movement down here, all these down closed candles, the opening on that candle starts this series of delivery on the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. So with that, I want you to think about how this is useful. Okay. Number one, you're looking at London highs and lows, the session for London open. Okay, for instance, like 2 o'clock in the morning to 5 o'clock in the morning. New York time. Every time I tell you, just always set it with New York local time. 2 o'clock to 5 o'clock in the morning. That's your London session. What's the highs and lows of that session? Okay, that's important because the market's going to probably sweep above those highs or sweep below those lows and create situations like this. Okay, and the New York session is 7 o'clock in the morning to 10 o'clock in the morning, New York local time. Okay, what's the session high and low for that? And do the same thing for Asia. Okay, 7 p.m. to 9 p.m. And that's it. Those are the 3 times of the day that I'm looking for specific key highs and key lows. And any intraday high and low forming right before the equities open at 9:30. Pretty easy, right? The hours of operation, again, are generally between 8:30 in the morning to 11, but it can be extended all the way to New York lunch, noon. I do not tend to take trades after noon local time, New York. All right, so we talked about internal range liquidity, and internal range liquidity is looking for short-term lows or short-term highs inside a price leg that we're retracing back into. Okay, that's all it means, internal range. Liquidity is a short-term high or low with stops above or below it, or an imbalance in that same range of price action. And I taught you market structure shifts. Showed you exactly all that's necessary. That is all that you require. And the skill set of identifying pools of liquidity, that is going to be something you learn rather quickly just by going through old data and looking at the times of the day I gave you in this lecture.